All right, good morning, good morning. Welcome to Market Pulse this Wednesday. Of course, we want to look at the recent performance of the banking sectors and particularly the credit issues that we have seen in the market, because a new trend is sort of emerging. And looking at some of these banks that have subsidiaries in the region, we're seeing a lot of growth coming from the region. And to help me with this conversation this morning, I'm joined by Stella Soke from Standard Investment Bank. Stella, karibu to the program.
Thank you, Jimmy.
All right, so I just want to understand, first of all, when you look at the half-year performance for most of the lenders and banks operating in Kenya, what pattern are you seeing?
So far, the banks that have released their results, we are seeing a decline in the lending in the Kenyan market. With the other subsidiaries, the credit growth is a bit consistent, but when it comes to Kenya, we've seen muted growth. Banks are the ones that are reporting growth are reporting very minute growth, and others are reporting declines on a quarter-on-quarter basis, while for some, they're reporting a decline in both quarter-on-quarter and as well as year-on-year basis.
Yeah, and then therein lies the question, because what explains this decline?
Well, I look at three things. Number one is the issue of elevated credit costs. We've seen very high interest rates in the first half of the year so far, and this is with reference to the benchmark rate. So if you recall, in February of 2024, the central bank raised the benchmark rate to 13%.
Yeah.
And these are levels that we last saw back in 2012, thereabout. So this meant that credit just got more expensive, and especially factoring in the issue of risk-based lending. So with risk-based lending, we have people with a poor credit score get money credit at a very costly rate.
Yeah.
So with that, then you look at the subdued macroeconomic environment and you see that we've come from crisis to crisis. We started with the issue of the floods back in March to May, and then just after that, we jumped right into demonstrations regarding the rejection of the Finance Bill 2024. So when you get this combination of a subdued macroeconomic environment and a very expensive credit, then this you get to see is the perfect recipe for non-performing loans.
Yeah.
Again, if you followed very well and closely, you get to see that non-performing loans have escalated from about a level of 13% ratio at the beginning of 2022, and now we are looking at a range of 16% and above as at the end of the first half of 2024.
Yeah.
So that's number one. Number two, we have the issue of the appreciation of the shilling against major currencies, the relevant currencies that we track. So for banks, they have portfolios with foreign currencies and portfolios with local currencies.
Yeah.
So for the portfolios with foreign currencies, they had to adjust accordingly to factor in the appreciation of the shilling. And just like public debt for Kenya, where we see the loans that we owe to foreigners decline when the shilling appreciates, then for banks, it happened so that the portfolio with foreign currencies also declined. So this is also a factor that came into play. And then number three, we cannot absolve the government of its role in this particular phenomenon, because crowding out has been so significant in the past few months.
Yeah.
So government securities have become very appealing and attractive to banks, and you leave the banks with no choice when you tell them to lend to these consumers that they find very at very high risk of default because, again, of the high credit cost and the subdued macroeconomic environment.
Yeah.
And then we have on the other end very attractive government securities and short-term securities for that matter. So you're looking at an inverted yield curve, for example, with short-term securities with very good rates and longer-term securities with relatively good rates. So banks, of course, will lend to the government, and then they will just neglect the issue of lending to the consumers or clients. We also saw some banks lending or shifting to short-term lending. So the they're looking to mitigate risk as well as manage their liquidity.
Yeah.
And this has also meant that most of the loans matured within a short time. So that's the decline.
All right, because again, Stella, I mean, we've been talking about risk-based pricing, but for a lot of customers, they're saying there has been no difference. I still get the highest rate that banks can offer. Why do we have that disconnect?
Well, I wouldn't talk much about how the risk-based model really banks do it,
Yeah.
but the general overview is that the person with the highest credit score, or with a very good credit score, gets to get a good rate for the credit, but the person with a poor credit score will get a poor or a high rate. So how banks determine whether you have a good credit score or a bad credit score,
Yeah.
that is where the disconnect may be coming about.
All right, because I mean, it just seems to be a blanket accusation that everyone has a bad credit and so will give you the highest rate. But again, we're entering into a season of monetary easing, and I just want to understand, are we likely to see the trends, particularly in as far as lending goes, start to shift? I mean, we just saw the CBK lower the rates by about 25 basis points, but what impact is that likely to have if that continues? And also just looking at where inflation is, because the argument from CBK has been we are tightening to try and make sure we take care of inflation.
Yeah, it should infiltrate into the banking sector, but as we always say, the banks are very quick to raise the lending rates when we have a rate hike, but the issue of reducing the rates when rates start to ease again takes time. So my sense is that given that uncertainties and risks have grown so much into the economy right now, we had the issue of the downgrade by Fitch as well as Moody's. There's generally high risk for businesses and everyone else, because you also saw the same rating agencies downgrade some of the banks' credit score, because again, you can't have a good score when your country has a poor score. So this blanket issue of increased uncertainty and risks may have an effect in terms of may affect how fast we go back to lower rates for credit in the country.
All right, and because again, Stella, looking at most of our lenders that have a regional presence, when you look at the performance from the subsidiaries, it seems to be on the rise. When you look at the Kenyan subsidiary for some of these lenders, they seem to be struggling. So what is that about Kenya, or particularly as far as the micro go, that is making it harder for banks to do business? Or what trends are you seeing in the Kenya that is making subsidiaries seem to outperform their Kenyan businesses?
Well, Kenya is an interesting market, and we've had a lot of noise, just to say, for some time now. We've had, beginning of last year, just when the Kenya Kwanza regime came into governance, we've had so much going on for the last 1.5 years. We had the Finance Bill 2023, which again was very contentious. It had its own share of contention. It went to litigation, and now we are getting to see things like the nullification of the same. We finished that, then came into the floods that we've just spoken about, and then demonstrations. So there's too much uncertainty in the Kenyan market. You don't know just what will come up next. So, and businesses don't do very well in an uncertain environment or a very risky environment. So I'd say that that is one major issue that is making it difficult for businesses to operate in Kenya, including the banks themselves, because when you're dealing with an uncertain environment and you're dealing with you're a service provider, then it becomes difficult also for you to be able to serve your customers best.
All right, and again, just looking at this downward trend, when can you say this started, particularly when you look at major banks sort of reducing their loan portfolio for the Kenyan business? When would you say this trend started, and what informed that from what you have been able to see?
Well, from last year thereabout, from June thereabout, because that again is when we started seeing the issue of high interest rates, both on lending, on credit, as well as government securities. So high rates from government securities meant crowding out, and then the high cost of credit meant that lenders will now become more cautious in assessing the credit worthiness of a borrower, as well as just taming how much they lend to the consumers to avoid or mitigate the risk of non-performing loans being elevated.
All right, and speaking of NPLs, we've seen in some cases banks are increasing their loan loss provision. Is that a sign that maybe this trend is likely to continue into the second half of the year?
Yeah, that will be my view, because we are not seeing any signals of rates coming down, because even with the recent, for example, issuance of bonds in the primary market, the rates were particularly very high, considering that we had started seeing a slight reduction in the rates. So I'm not seeing any time soon having rates to going down. So the trend might continue in the second half. That is my view.
All right, so looking at the different asset qualities, how has that changed?
For the few banks that have released the asset quality, there's a mixed performance. Some have had an improvement in the asset quality, some have had a deterioration in the asset quality. So this again is reflective of the environment, that consumers have not been able to meet their obligations in terms of repaying back their loans.
All right, and I know you've talked about the uncertainties, but could there be other macroeconomic factors that are leading to these high NPL rates that we are seeing?
There's the issue of demand. You see, as much as inflation, the figure has been declining, or there has been a slow growth in terms of prices, we're still seeing or experiencing very high costs of living. So what this means is that demand for commodities will go down. So when you look at the businesses that operate in the service sector as well as the manufacturing sector, you get to see that demand has consistently gone down, because consumers are spending much on the necessities and not the other things. So lower demand means that the output will be muted, and thus less profits for these particular investment businesses.
Let's talk about fiscal policy, because again, this is a major player in terms of access to credit for a lot of Kenyans and a lot of customers for banks. And the question is, when you hear the government say we want to reduce our domestic borrowing by this and this margin, does that then translate to a lot of credit in the market that requires uptick from the private sector? Because again, I would want you to compare the credit to the private sector over the last half or over the last couple of quarters, and tell us what you're seeing in that space.
In terms of the fiscal space, domestic borrowing has been higher than external borrowing, because I feel like this is more accessible to the government. It is expensive, very expensive, but it's more accessible than external loans. Yeah. And in the last fiscal year, as well as in the current fiscal year, we are seeing a huge shift to the domestic borrowing. So for example, for the current fiscal year under the second supplementary budget, the ratio is 62 to 38. So we are borrowing 62% of the fiscal deficit, or we are plugging in the deficit using domestic borrowing. Yeah. So this means that the trend of crowding out will continue to play in the domestic market or in the macroeconomic environment. So there's no particular hope, if I could call it that way, that we will see a decline in the crowding out effect by the government, because the fiscal space, again, is very uncertain. we do not have a finance bill for the current fiscal year,
Yeah.
and the Finance Act that we were using, the one that was enacted in 2023, again is in contention and in litigation. And we are not seeing any particular positive response or judgment by the Supreme Court.
Yeah.
So the fiscal space will continue to remain uncertain, and this means that the government will continue to largely depend on borrowing to fund most of its budget. So the crowding out effect will continue for some time.
All right, so where do the customers then turn to? And also, as we wrap up this conversation, just looking at the second half of the year, what do you see changing in that space, and what needs to happen for us to reduce the NPL ratio?
To reduce the NPL ratio will largely be determined by how fast or how quick the business environment shifts to the positive side. And there's also the issue of pending bills that I might have forgotten to mention, because you see most of the suppliers and contractors who work with the government deal or struggle with the issue of pending bills. And then when you look at the budget, the government has not allocated any funding to pending bills, which means that these people will continue to ask for their money with no particular response in terms of them getting paid. So these are people who probably got loans from banks, and they are part probably of the non-performing loans, which means that the government has a role to play, and in terms of meeting its obligations with regards to the pending bills. With the business environment, we need to see a shift, and this again will depend mostly on the operating environment, the ease of doing business. You see the issue of input prices, the import prices. At least we have the issue of the appreciation of the shilling, so people or people who importers have a bit of price easing because of the appreciation. But we also have a very difficult or expensive business environment with regards to input costs because of electricity, and also the issue of tax burdens, because again, the Finance Act 2023 is still in play, and people are still paying taxes with regards to that particular act. So there's that issue of difficult or a bit of expensive environment to operate in. Yeah.
All right, so Stella, there's something you mentioned that I don't want us to lose focus on that, and that is the fact that once the Kenyan shilling appreciates, there seems to be a reduction in terms of revenues for banks. And I just want you to explain how those two works and how they align.
That's why I give the example of our public debt. You see, when the shilling appreciates against the dollar, then the debt that we owe to them, as per the current foreign exchange rate, goes down. When the shilling depreciates, then the debt goes up because we are using that movement in the exchange rate. So it happens the same for banks, because banks also have portfolios with foreign currency loans. There are people who have borrowed in dollars, so if the shilling appreciates against the dollar, then the value goes down because the rate again goes down. So overall, the portfolio, the loan portfolio, both in local currency and foreign currency, will go down, despite the fact that probably loans in the local currency have increased.
But the expectation, Stella, would be that a lot of these banks, most of their portfolio, and I'm just randomly picking a figure, probably 50–60% would be in local currency.
Yes.
The question that for someone listening to this conversation might want an explanation to is, how then do we explain the significant reduction in the loan portfolio?
The issue or the factor of currency appreciation is just one factor. Actually, the ratio is the portion is very little. It's below 30%, because according to CBK, in the latest MPC press release. So it's just one factor, and that's why we mentioned two others. So that is one factor that led to a slight decline. Then we have now the issue of crowding out and the issue of cautious lending by the lenders. Yes, so it's the combination of all these issues that now give muted growth in the lending.
All right, so Stella, as we finally wrap up this conversation, when you look at the macro environment, what do you see as the headwinds that we are likely to face in the second half of the year, and how will that affect credit uptake within the market?
As mentioned earlier, one of the headwinds that we will likely continue to see is the crowding out, because government is still in the market borrowing a lot. So that is one of the issues or the things that we will see. There's also a bit of uncertainty with regards to the finance bill. We've seen a bit of hints from the president as well as the new CS Treasury that the finance bill, some aspects or facets might come back, the positive ones or the ones that didn't face a lot of contention. So with that, there's uncertainty for businesses, and now the issue of the lenders or the banks shifting their lending to the government as opposed to the consumers, ordinary Kenyans.
All right, Stella, thanks so much for making time to speak to us. And of course, that is how we wrap up this episode of Market Pulse. You can watch and listen to this podcast or show every Wednesday on Citizen Digital as well as Hot 96. Let's do this again, same time next week.